Welcome to the Jill on Money Show. It is Wednesday, May 29th, and we are here trying to help you make better financial decisions. Sometimes we do that by inviting you to come on the program with us. If you love that idea as much as Mark and I do, all you need to do is go to jillonmoney.com, click the Contact Us button, complete the form, and of course, check that box that says you want to come on the air live. But if you're shy, I get it. It's okay. The form will just become an email, and we love getting your emails as well. While you're on the website, don't forget you can subscribe to Jill on Money Live. That is our paywall, and it is a low paywall, $35, which gives you access to quarterly live webinars and lots of cool bonus video content. And you can also, if you're liking the video thing, check out our YouTube show, Jill on Money, powered by The Compound. All right, today, let's do some emails. I hate when they pile up too much. I know I'm supposed to let it go, but it's still hard for me. This is from Ty, who says, I haven't heard any podcast on tax harvesting, and my financial planner wants me to start doing this. I'm confused. Okay, Ty, tax harvesting is amazing. We talk about it usually towards the end of the year, and it's usually just a way to think about managing your tax liability. This is obviously in a taxable brokerage account, not in a retirement account. Gang, remember, we don't pay taxes on the changes you make inside of a retirement account. But, the way that it would work is that you look at the account, I would say just an annual basis, because remember, we're trying to minimize the tax hit. And what this is allowing you to do is that you make sure that you sell something at a loss at the same time you sell something at a gain. And the gains and the losses wash against one another. You don't have to pay tax on that. However, if you have more losses than gains, which is kind of hard to find right around this time when markets have been trading higher, but if there are losses, you are allowed to take up to $3,000 of those excess losses against your ordinary income every year. Now, if you have one bad year and you had to pull the trigger and get out of something, those losses pile up. If it's more than $3,000, you get to carry it forward every single year. So there have been times where people have had big losses on something, and then they find themselves like, wow, I have company stock and there's huge gains, and you can use the gains against the losses. Hope that helps. Nancy writes, there's a question about selling a home. Hi, I live in the Bay Area and I owe $324,000 on my mortgage. I have a 2.5% 15-year loan with 13 years left. My husband and I are both 55 years old. We don't have a ton of liquid cash, but we have 2 401ks and a pension. Okay. No other debt other than the house, which is worth $1.5 million. And I'm curious if I should sell this house, pay off the mortgage, pay the realtor and the capital gains, and buy a new house for $1 million in cash and be mortgage free. Would like to know if this is a good idea. It kind of depends whether you like your house or not. I mean, a 2.5% 15-year loan is pretty amazing. So I think there's a couple of components of this. Number one, do you love this house? If you love this house, stick around. It's not a big deal. We'll figure it out with you. If it's too big a house and you just want to actually make your footprint smaller, then sure, this can make a lot of sense. I just think it really depends on your situation, how much you love the house, and can you really get into a house for $1 million? That's my other question, because often we'll talk to people and they'll say, yeah, I'm trying to downsize, and they can't. So sometimes the cost of moving and redecorating and doing something, it does add up. So the answer to your question is, should you? Is it a good idea? It could be, but I'd love to know more about what else is going on. Like the real qualitative, not the quantitative part. Okay. This is from Claire. Another house question. Dear Jill and Mark, I listen to you the first thing every morning, and I love your straightforward and get to the point style. Here it goes. Here's the question from Claire. How should we invest $240,000 from the proceeds of a vacation home sale as if we don't have it? Maybe T-bills and index funds? Okay, hold on. We've got multiple offers on an 11-acre lot with a pond that we bought for $350,000 back in 2012. Should we sell when my husband retires in 2 years to avoid capital gains or leave to our kids? I know we need to move a lot of money from 401k to Roth when my husband retires in 2 years, when he's 65 until he's 75. It looks too lopsided at the moment. What things are we not doing quite right? Okay. Oh, now I have the numbers. I'm sorry. I should have started with this. So they are 63 and 61. They've got 600 grand in bank CDs and the proceeds of that house sale. They've got $1.7 million in a 401k traditional, $22,000 in a Roth, $37,000 in an HSA. Add the Social Security, $3,400 at husband's age 67, $2,000 spousal Social Security at 70. You know what you didn't tell me, Claire? You didn't tell me how much money you need to live on. All right, I'm going to do this as if I know the answer to it, but I don't. So how should you invest the money in cash? I would use a diversified portfolio. I mean, I would definitely look at T-bills, but I might use bonds. I might use index funds. I would make sure that I have enough money available in cash so that you could pay for the conversion when your husband does retire. He doesn't have to do it all at once, okay? The question about the money on the multiple offers on the lot with a pond, I would take the money and I would add that to the kitty and invest it, because I don't know how old your kids are, but they're going to get the money one way or another. And I'd like you to have that liquidity as you start really starting to, focus in on converting that $1.7 million into a Roth. That you're going to need to do that over time, and you're going to need the cash to do it. Okay. Gregory says, my wife and I have about $1.75 million between traditional and Roth IRAs, 230 grand in a Fidelity taxable account, $500,000 in a traditional thrift savings plan, and a remainder of $1.1 million in a Roth. Oh my gosh, my government pensions cover all monthly expenses with money left over. I'm 61, my wife is 56. Most everything is at Vanguard in index funds and bond funds. And in addition to the $1.75 million, we've got some cash in T-bills and credit union, $160,000. All this is to say that I estimate that I'm 85 stock to 15% bonds. I'm in retirement. Should I be more conservative, like a classic 60-40, assuming I can survive the market tanking a bit? You know what's weird? So I think of this in two ways, Gregory. One is like, why take so much risk? You have plenty of money, and the money that you have is, the pensions are covering your expenses. So that one way is to just say, yeah, you could probably pull the risk back and be 60-40 if it doesn't, especially if you don't like the ups and downs too much anymore. Another way to look at it is that you don't need the money. You're investing it maybe for someone else. If you have kids or they're grown, you can stay that way. But this is about how you feel. If you're feeling okay about it, I'm feeling okay about it. Seems good to me. Okay, John says, oh, this is good. I first heard you in March of 2023 on The Compound and Friends with Josh Brown and Michael Batnick, and I've been listening to you ever since. I enjoy your podcast. I think you might be able to help me with a decision. Here's my situation. In December of 2020, I inherited my father's traditional IRA, which was then worth $760,000. My plan was to use the 10-year rule, let it grow tax-free until 2030, and then withdraw it all at once and pay whatever the taxes are at the time. The account is now up to $930,000. I know the 10-year rule is up in the air, but let's assume the IRS continues to waive required minimum distributions for inherited IRAs. Okay. My wife and I are both in our mid-60s, and we've got other investment accounts, brokerage, IRAs, 401ks, worth about $4.7 million. Boy, we got a lot of rich people today, Mark. Our gross income, $500,000 per year. Salaries only, not counting dividends and capital gains. I expect our gross income to drop to about $300,000 starting in 2026 when we both retire and take our pensions, federal government civil service, so we're not entitled to Social Security. We also plan to sell our current home when we retire. The house is worth about $1.5 million. It's got a $250,000, 3.3% mortgage remaining. We're going to be moving to another state, one with a higher cost of living, but that does not tax federal pensions. We'll buy a forever home for about $2 million. So here's the question. Should I continue with the original plan to let the IRA grow until the year 2030 and use other accounts to bridge the gap between the proceeds from the sale of our house and the cost of the new home? Second question. Should I start annual withdrawals now and gradually draw down the IRA so it hits zero in 2030, again using other accounts for the new home? Should I make a large withdrawal from the IRA when we move to cover the difference between the two homes? Thanks very much for your take on this. Such a big number, to do it all at once, your gross income at $500,000. I mean, you're kind of like in this situation where if you were to pull it out a little bit at a time, even now, I don't even know if it seems to me you're probably mostly in the 37% bracket if you were to do it all at once. Here's what I think I would do. Presuming the tax rates are the same, because I don't know what's going to happen when these tax rates sunset. I think in 2026, what I would do is 26, 27, 28, 29. So we basically have 5 years. I think that maybe that first year, if you're thinking about like pulling the plug on the house, selling the house, and then you've got to come up with other money, I would start to pull money out of the investment accounts. If possible, can you kind of stagger this so that we can pull the money out of your dad's traditional IRA over the course of the next bunch of years and then manage the tax liability? That's one idea. It's not perfect, and I don't know about all the timing, but I think ideally what I would like to do is try to get the money out a little bit at a time so that you can pull the money out and you're in the 35% bracket, not necessarily getting taxed at the 37% bracket. And I think that would work, and that's why I think I would do it gradually, using some of that money for the new home and other accounts for a new home. But we really want to try to minimize the tax hit. You're going to have a big one. There's no doubt. I mean, I guess the other alternative is to say, rip the Band-Aid off on the year that you when you retire, use the dad's traditional IRA, pay it at the 37% bracket, suck it up, use that money and be done with it. That's the only other idea that I have. The timing of it is really going to be the issue. And when you actually retire, what is the time of year? What is the gap? And how long will it take for you to get that new house? These are all really important questions. So I don't want to make it seem like this is a nothing question. It's a big question. And so if you'd like to follow up with us, I'm happy to have you on and talk you through it. Okay, I hope that helps. Well, that is it. That is the program. We thank you so much for listening. All of our content lives on our website. We would be delighted if you would like to subscribe to our Jill on Money live service. That's where you have access to quarterly live webinars and bonus video content, all for the rock bottom affordable price of $35 a year. No inflation here at Jill on Money. You can subscribe to us on the Odyssey app or wherever you find your favorite podcasts. So good to hear from you today, and so good that you continue to send all those notes. If you have a question, jillonmoney.com, click the Contact Us button. Put your hands metaphorically on someone's back. Change your work, change your wealth, change your life. Thank you for listening. We'll talk to you tomorrow.